Hello and welcome to this week's episode of Nucleus Investment Insights. Today's episode is called A Reluctant Embrace, the Australia-China Uneasy Partnership. With Anthony Albanese's visit to China and the recent easing of tariffs on some Australian commodities, is the strategic partnership thawing? It certainly seems this is opening the door for the remaining tariffs on things like Australian wine to be removed also. Trade relations seem to be improving, which will be a relief to many Australian commodity exporters, but it'll be greeted with caution and continued diversification in other markets. Today, we'll discuss the politics, trade, China's property sector, and declining demographics. Just a reminder, the information in this podcast is general in nature only and is not intended to be specific to your personal financial situation. If you do want to discuss your personal financial situation and how to improve that, you can book a call with me or one of the advice team at nucleuswealth.com/contact. Today, as always, we have Nucleus Wealth's Chief Investment Officer and co-founder, Damien Klassen. Damo, welcome.
Hey, Sam. How you going?
I'm well. My name's Sam Kerr. I'm the Head of Advice at Nucleus Wealth. Just a reminder, the themes discussed in this podcast are a reflection of our thinking, and we implement them across all our active portfolios. You can find out more in the description notes below about our offering. This show is recorded live every Thursday at 12:30 Australian Eastern Standard Time. So jump on the Nucleus Wealth YouTube channel and you can ask any questions that come to mind, and we'll do our best to answer them during the show. This podcast is also available on all other major podcast platforms, so feel free to have a listen there if you prefer. Until the end of the year, we are offering still a free, no-obligation super review. We'll give you clarity on how you're invested, the fees you're paying, the tax-saving strategies on offer, and the rules of the game. So you can book in at contact@nucleuswealth.com. nucleuswealth.com/contact. So that's all the formalities out of the way. So Damo, over to you.
Yeah, thanks. So we thought we'd use Albo's visit to China as a, sort of seen a few headlines popping up, and just wanted to sort of have a quick overview of what's come out of that. And I guess the shorter answer is not a lot, but we also wanted to go through and to sort of have a run through the latest China statistics, because there's been a few that at face value look like they've come out relatively well in recent times. The GDP growth's ticking up, and there's a few other sort of positive signs if you sort of look across the superficially. And so we wanted to sort of dig into some of those numbers and work out what's sort of really going on there. So I think I just want to take a quick back step and just sort of talk about the politics. So, Australia's obviously been in this sort of a detente with China for the last little while, where a lot of the trade which we do with China has been either outright banned or at least shadow banned, in terms of China not accepting deliveries or having reasons as to why they don't take Australian exports. Now, that hasn't extended to iron ore, because they haven't got another source of it, basically. It extended to coal for a little while, but then we had a bit of an energy crisis, and so then they took it off. So it was clearly just I guess a coercive sort of play to try and get Australia to play ball a little bit. I think there's lots of other places that will go into the history of it, but I guess for me, the nutshell is China was doing a lot with Australia. They tried to I think extend their soft influence throughout Australia a lot. That included paying some politicians some quite reasonable amounts of money to do not a lot, and they sort of got various whether they got a port in Darwin on lease, and then paid the politician in charge of that $1 million a year to be a consultant after they left, or donations they were making to various parties, and then Sam Dastyari sort of got caught up in that, and that sort of blew the lid off it a bit, and Australia sort of ended up with a real pushback. Then we sort of fast forward to Scott Morrison making some, I guess, looking at trying to launch an inquiry into the sources of COVID, and in response, we saw China come back with 14 demands that were sort of leaked, so to speak, from their embassy, and those 14 demands were, a whole range of different things, but largely, basically saying, look, we'd like you to become a vassal state. We want you to crack down on your free media and all these things. We want you to we want you to let our companies buy whatever they want in Australia, and so a list of demands that were sort of, I guess, what they'd possibly done in a few other sort of developing countries, and Australia was sort of like the first go they'd had at a developed market to try and do the same thing. Where in some of the developing countries, they sort of came in with a similar type of thing, set up lots of trade, pay politicians lots of money, and then come in and demand better access and whatever it is. And so Australia was sort of like their first test case. That didn't work, and that's where we ended up. Luckily for Australia, we've got a very backward economy when you look at sort of the complexity of the Australian economy. And what that means is we've got lots and lots of commodities, and commodities are fungible. So yes, our barley didn't go to China anymore, but there's only a certain amount of barley in the world, and so what happened was China basically bought a lot of the barley that was going to head to the Middle East or into Europe, and that's where Australian barley ended up instead. And so everyone just shipped things a little bit further, but the reality was, commodities are this type of thing where it doesn't really matter where they're coming from. So Australia really didn't get as affected, I think, as much as what China might have hoped. I think there's a few parts where it probably did get affected, and the main ones is students and tourism. They're ones where, there's not a, so if I can't sell my beef to China, well, there's China's still demanding beef. They're buying it from, say, Brazil, and so we're now shipping to somewhere that Brazil might have shipped to. On the tourism side, there's not like another group of people where there's a few hundred thousand Chinese people don't come to Australia. Well, that's not going to get made up from somewhere else. So that's one front. If you're looking for a thawing of the relations, where you could see some positivity and some positive pickup. So the tourism. And possibly more students. Having said that, we've spoken a few times in recent weeks about the number of people coming into Australia and how it's at record highs and and causing problems for inflation. So maybe if there's a thawing in China, we could see more Chinese students come in, and that might exacerbate that those problems. But I think the bigger problem coming out of China is actually working out what's the economy looking like, and are we seeing some recovery, and are we going to get back to the phase where China's growing relatively strongly, and that sort of and Australia as a large commodity producer and as a big exporter into China, that's where we get a pickup in the price of our goods and things like that. So that's what I wanted to sort of run through today. I'll probably worth prefacing it by just saying, I've got a chart up showing, this was from the FT, a great chart sort of showing why a lot of this is guesswork and a lot of it is estimation and trying to use third-party sources and trying to marry things up. So the chart I've got up is showing the economic indicators made available by the Chinese National Bureau of Statistics. And so, for anyone listening in, not watching on the podcast, it sort of starts back in the 80s, say, with a few hundred sort of data series. And as China opened up, that sort of grew quite sharply. So by 2000, so I guess by the late 90s, you're up to 20,000 data series. By the early 2000s, you're at 40,000. By 2010, you'd reached 80,000 these data series. And then Xi became the leader, sort of 2012. And since then, we've just seen this precipitous decline in the number of statistics that are coming out. So they've literally just stopped publishing tens of thousands of economic statistics. As whether that's because the numbers are bad and they don't want to show them anymore, or whether there's other reasons behind it, it's hard to say. But we're back well below the 40,000 level, and although there is still data to come out for 2021 and 2022, like we're back under 20,000 series of statistics that have been put out. So we're all a little bit in the dark as to what's going on, and there's certainly recent signs we've seen where youth unemployment was well over 20%, and so they stopped publishing that data. The land sales is one which is pretty key for me, and we'll move on to that soon. But land sales is another one where China's very dependent upon it. Chinese local governments are very dependent upon that for funding, and we just have no idea what's going on, or we have to look at third party statistics and surveys and things like that to try and work it out. So I'll start with the GDP. So we saw GDP growth tick up in the recent quarter and came in sort of above 5%. And so there's this discussion about saying, well, is China back? 5% GDP growth is pretty good. And that's true. 5% is good. There's a couple of things about Chinese GDP, though, that are important to note. And there's one thing in particular with this one is that when we're talking about GDP, what we're talking about is what we call real GDP. So it's adjusted for inflation. And so the idea is that when GDP is up by 5%, that means the production of all goods and services is up by 5%, and you sort of ignore the levels of costs and inflation and deflation. So typically, when we had Chinese GDP much higher, sort of during the early 2000s, where China might have been doing sort of 10 to 15% in GDP, then you added on inflation. So in nominal terms, it was probably doing closer to 20% in terms of its growth rate. The issue we've got right now is it's gone the other way. So China's got deflation. So while you've got a while you've got real growth of 5%, the nominal growth is basically as low as it's been, except during the COVID period. So it's at sort of 3.5%. And the issue is for that is that so there's two parts to how you look real and nominal. Real's important in the long term because are we genuinely getting a improvement in the quality of life over and above inflation? The issue with nominal, though, is we live in a nominal world. So and most particularly if you have debts. So debts are nominal. So if I take out a $100,000 loan for a business of some sort, and that business is making me say $10,000 a year, and inflation's running at 5% per annum. Now my loan's sort of locked in at whatever rate I'd set it at, but if I'm just getting that 5% per annum growth in my income every single year just because of inflation, then my debt becomes easier and easier to pay every single year, even if my business is going nowhere. All I'm doing is picking up from inflation. And so, so if you've got lots of debt, inflation's a good thing. Assuming that you're getting the benefit of that inflation. The issue in China is they've got truckloads of debt, way more debt than they had in the early 2000s, and that debt, is where you're seeing this. Because you're not getting because the nominal GDP growth is really low. That's where you're seeing the problems in terms of that debt. Is you just not. If you had this high nominal growth, even if your real growth was low, but you had certain high nominal growth, then at least you could be sort of going, well, getting closer to paying off that debt. But actually, the problem they've got is it's the other way. The other issue with Chinese GDP is, by and large, they don't write things off. Just the way their calculation is set up and the way their standard practices are is that if you, for example, in a Western country, you build something. Say you build an airport and it costs you $2 billion, and then nobody uses it. It's sitting in a city that's didn't get the growth you expected. You'll see a write down, and that will come back and that will affect your GDP within most Western countries. Within China, that doesn't happen. So the issue they've continually got is they're building all this infrastructure. A lot of the infrastructure is very much underutilized. There's always these pictures of ghost cities and unused highways and bridges to nowhere and things like that. You don't see that in Chinese GDP. You don't get the negative effect of that. It's only ever put in there as the positive that you spend on it, and you never see those write-downs coming through. So GDP, the real GDP actually looked pretty good, but looks worse on a nominal basis. And then the second thing is it's probably overstated, and we're probably going to get that this overstated issue in terms of write-downs is probably getting worse than what it was in earlier years, just because of the amount they're spending.
Damo, I've just got a question. So in the Western world at the moment, we've all got inflation, but in China there seems to be deflation. What's the structural difference? Why are they going the other way at the moment?
Yeah, it's a very good question, and it probably comes back to the crux of this whole, how do we get out of deflation? What's it causing? So look, I'll preface this by saying central banks, when you bail them up and talk to them seriously about inflation, is they don't really understand completely where it comes from. So they talk a lot about it, but there's lots of different estimates of where it's come from, but there's no real consensus about exactly what's causing a lot of this stuff. So I'll give you my take on China. Is that China has very much been what we saw within Western countries was a lot of people were prevented from working, and then on top of that, they were then given a whole bunch of handouts. And so in a way, what we did was we shrunk the supply of goods and services, and we gave people more money. And lo and behold, people wanted to go out and spend on things. And so we had this mismatch. And so more money, and that saw this inflation sort of spike. China, that's not the case. So China didn't do large-scale handouts to individuals. They did some handouts to companies, but for a lot of individuals, what would happen was you were locked down, you couldn't go to work, and you had to eat into your savings in order to survive. And so the issue in China is their savings rates, are quite high and jumped a little bit higher with COVID. And so the issue is this now a part where companies have been subsidized, so they're still producing lots of goods, but consumers are actually a lot more circumspect than they used to be. And you've got the whole housing market sort of hanging over them. And so consumers are trying to save in case they get locked up again, and they want to make sure they've rebuilt their savings. Whereas arguably, the opposite's happened in Western countries where, the message was, well, maybe you don't need as much savings buffer as you thought, because if something goes really wrong, then the government will step in and start handing out checks.
Yeah, okay. Well, I mean, that's a pretty good explanation from where I'm sitting. It all adds up. It's logical. So, let's roll with that.
Yep. And so, so anyway, so let's jump into having a look through some of these sectors. I mean, one of the key things, we'll go back. We've done a fair bit on property developers recently, so I'll run quite quickly through these ones. But I've just got China Vanke, which is another major Chinese housing developer that, I think I saw something talking about it being China's largest, but that's only because, the original largest fell over, and then the next largest fell over. China Evergrande sort of fell over, and then it was Country Garden was the largest, and they've had its problems, and now we're into China Vanke. So just in the last couple of days, we've seen the bonds here, which you're expecting to get back $100. Basically, this is their debt, so people are expecting to get back $100 or something close to it, and now that's really tumbled in recent times back to sort of $70, which is sort of implying a much larger chance of it going bust. And they look like they're the next cab off the rank in terms of the major developers to start coming under pressure. And I just want to remind people, we've got another podcast up before, and I've got a few posts on this on the website. But basically, I've got a list here of Chinese property developers, of their debt to enterprise value, their inventory to sales, and I'll throw some other ones in a minute. But China Evergrande is on this right at the top. Country Garden is sort of in the middle. China Vanke is fourth from the top there. They really don't look significantly different from all the other Chinese home builders. So they've all got lots of debt. They've all got these massive inventory overhangs. Then when you jump through to look at how much the unearned income, so basically they've properties that have been paid for but they haven't yet built. They've all got massive amounts of those. So China Vanke's sort of got over 100% of its sales, of its annual sales, are properties that have been paid for but haven't been built. And then if you look at accrued expenses, then this is employees and the suppliers who haven't been paid, and China Vanke sits in the same with everyone else, sort of well over 50%, which is basically saying they're more than 6 months late on paying their bills for employees and suppliers. And so I guess the message is, this is not, China Evergrande was not like a bad apple that just happened to get found out and everything else was fine. And neither was Country Garden, and neither is China Vanke. They're all the same. They're just it's just a question of when the debts are coming due and when each one is going to roll forward. And our take is very much stays the same, is that China is basically, they're not letting these fall over. By any means, they all should be insolvent. And you work out what's going on, but you try and wind things up from there. But the problem is they've all taken massive prepayments for properties. And so our take is that the Chinese government is basically treating them as utilities, giving them enough money, keep them alive long enough to keep building these properties that people have paid for. And then once they hit a certain stage, they'll let them fall over. And I guess there are some, I just want to highlight one of the paradoxes, so to speak, in this as well, is that not only have they taken a lot of money for houses they haven't built, but they've also got all these houses they have built that they haven't sold sitting on their books. And so why is that the case? Well, we built a high rise over here that, say, we had 20 or 30% of people had prepaid for, and we used that to build this high rise. Now we're trying to sell the 60 or 70% of it that's still left. And in the meantime, we've still got another 20 or 30 people who have paid for in a new high rise that we haven't even started yet. And so they're facing problems selling the stuff they have, and issues with having to buy the new ones. So that's if you look at the latest in terms of the loan rates, we're actually seeing mortgages contract for the second straight quarter. So they hadn't contracted before last quarter, Q2, and then we've seen that again in Q3. So Chinese consumers are certainly not rushing to go out and get new property. If you look through the transaction volumes, they're sort of down 5% on the prior year and still well down on previous years. So there's certainly no real turnaround on that sort of fast moving data. If you look at the longer term data for starts, now we do two different versions of this. One is you take the starts that China says is happening, and then the other one is you can do this implied net starts, which is basically saying, because the numbers don't add up. Basically, the numbers don't add up, and so they say, well, they give us like 4 or 5 numbers. Maybe if we assume that the starts is wrong and the other 4 or 5 numbers they've given us are right, what does that imply that starts are? And so starts have already fallen well below prior ones. They're back to sort of early 2000s levels. And if you use the implied numbers, they're actually well below that again. They're back to sort of levels not seen since almost 2000. So there's not a lot going on that front. We think iron ore is holding up though, because, well, it's actually a little bit hard to tell why it's holding up as well as it is, but partly because there is this mantra that they still need to keep finishing the ones that they've got in inventories. But basically no good news on the China housing front. So that leads us to exports. So could exports be the thing that's going to save China? And we've certainly seen in recent times. I've got a chart up from Bloomberg, came out recently, which is just sort of showing how fast the bank loans have ballooned into this industrial sector. So they've basically doubled the level of loans into that banking sector, into the industrial sector in the last 3 years. And you can see that the time before that, they were putting all that money into the real estate development sector, and then now that's sort of frozen, and the new place has been the industrial sector. Now, maybe exports will come good, and they'll create all these great computer chips and start selling them to the rest of the world. So I doubt it at the moment. We've certainly seen exports have disappointed again. They were out just the other day, sort of down 5%, over 5%, and considerably worse than what people were expecting. So, look, maybe there'll be some export boom, but at the moment it's not looking like it. I've got a few pictures that I threw in as well from recent ones. We've all seen the pictures of masses of e-bikes, but there's also a pretty decent electric vehicle war going on, a pricing war going on in China, and they're trying very hard to export a lot of the electric vehicles that a lot of them have been subsidized and built in China. They're trying to push that to the rest of the world. So maybe, but they look like they've still built so much, and they've got so much extra overcapacity that it's there's literally lots of these cars that are electric vehicles that are sitting there with sort of grass growing over them and trees and stuff like that because they're just not selling enough of them. So I do think exports, they're not. I think they'll. It will be helpful, but it's not. It's certainly not going to save them. And the size of the Chinese economy now relative to the size of the rest of the world, the amount they need to grow their exports by would be so huge for everyone else that they're unlikely to be able to do so without significant pushback elsewhere. And then the other thing I just want to note on the exports is as I spoke about, there's the unemployment stats were they'd stopped putting out unemployment stats for the youth unemployment. We do have some survey data on employment, and that's looking pretty dire. So I've got a chart up just showing the non-manufacturing, so effectively the services economy and the manufacturing. And I'll dig a little bit more into this a little bit later as well. But both of those are very much contracting. So on this chart, if you're under 50, then you're contracting your employment, and if you're over 50, you're expanding. And so, basically, employment hasn't been expanding for a long time, but it's certainly looking a lot worse now, and sort of back to most of the depths we saw for a lot of that COVID period in sort of 2022. But yeah, anyway, back to you, Sam.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show. Just one more quick thing. We just want to ask you for a simple favor. We want to spread the message about transparency, innovation, and integrity in investing. At Nucleus Wealth, we live and breathe these values. We would love it if you can help us spread that message, and subscribing to our channel will help us do that. We would be most grateful if you can hit the like and subscribe button now.
Right, so the other thing that could rescue it, and we have seen another package sort of announced in terms of China, is the infrastructure side. So I've got a chart just sort of showing Chinese steel use and how basically they use twice as much as what Europe uses in terms of the construction side. And so the question for me is very much when does China stop building bridges to nowhere? And that's going to see construction sort of significantly come down. The issue is that they're already running their infrastructure basically as fast as they can. Got a chart up that I put in one of my prior posts to sort of showing the number of bridges. So the one of the things people often talk about in terms when they're talking about infrastructure projects that don't add any value, they talk about the bridges to nowhere, and because that was what Japan spent a lot of time in particular building, is just bridges everywhere and roads everywhere and just things that people wouldn't use, but it was trying to get the economy going. Now, this is Guizhou, which is one of the poorest states in China. It's got, I can't remember the number. I think it's something like it's got 7 out of the 10 highest bridges in the world or something like that. And you can just see that it's just gone exponential in terms of the number of bridges it's producing in this, quite backward poorest states in China is literally going exponential in terms of just building more and more bridges. And that's sort of reflected in the debt numbers that we see out of China. So the idea is you're already running at this great rate of knots in terms of producing these things. Last year I built 30 bridges in this poor state. If I don't build 30 again next year, GDP is going backwards. So I've got to go, and if I wanted to go forward, I've got to go out and build, 33. And then the question is, well, can you build enough to get to actually make a meaningful difference? And I guess the thought which we have is, look, it's already running at such a fast rate. Yeah, sure, they could probably go a little bit faster, but you're really starting to reach the limits. And more importantly, all this is government debt funded now, and they're using more and more debt. So back in 2000s, when we had GDP growth of 15% and 20% nominal GDP growth, you take out a $10 million to build yourself a bridge, and that improved the productivity in the region, and you were growing at 20%, and you got all that money back really, really quickly. Now what's happening is you're spending way more on that. You're spending twice as much to build the bridge because all your costs have gone up, and you've already got 6 other bridges in the immediate vicinity. So it's actually adding almost nothing to your productivity, and it's costing you all this extra debt to do it because you haven't got the same effects. So we're certainly seeing a big tick up again. So this year, in terms of this is the bond quota. I've got a chart up just of the bond quotas. So the amount of bonds that have been issued by both central governments and local governments is now above the levels that were done during COVID. So the sort of special level you reached. So COVID basically almost doubled, not quite doubled, but up sort of 60-70% on the year before, and we're above that. So versus 2019, where we're probably up 80% on that prior number, and we're more than double what we were in 2018. So there's already a lot being spent. And the other problem you've got is this is all being spent by local governments, and they don't get any of the money. So we've got this problem we spoke about before, where local governments get a lot of their funding from selling land, and that's one of the stats I was saying that they've stopped publishing. So basically what would happen is local governments sell the land to a developer. Developer comes and develops property there. Then the local government gets to collect taxes on it, but they've also collected this money up front, and they're using that to sort of fund their hospitals and schools and roads and other things that they're building. Now, land sales collapsed. We believe it's still collapsed, and we've seen sort of local governments now have gone from having to spend sort of 50% of what was spent in China sort of back in the 90s to they're sort of reaching a record this year of their general spending sort of 85%, and they're just not getting the money though. So they've got their expenditures are increasing, and their share of their share of revenue has collapsed. They managed to get away with it for sort of 15, 20 years by selling off all the land, but people are no longer buying the land. And so something has to change in terms of the structure of how they're giving. You either need these big transfers from central governments, or you need to change your structure of your taxes so they actually come back to something that's actually sustainable in the longer term. So, things still getting worse. Is it imminent? No, it's not imminent, but it's obviously something that sort of can't keep going on in terms of that. We've got there are some shadow banking problems. There haven't been too many major ones that pop up in the last little bit. So there's still the certain problem certainly hasn't gone away, but there's we spoke about it before being a dangerous cliff, is that there are these shadow banks that have lent money into the property sector, And the more we see these property companies falling over, the more you're going to find just weird places where the money was cropping up and debt that you just didn't realize happened. So that was probably one of the bigger points that I didn't address actually was when I showed all those property developer statistics and all the debt that was out there. So they basically have about, for every dollar worth of equity, they have about $9 worth of debt. And the issue, one of the issues is that's just the debt we know about. So that's the on balance sheet debt, and almost always whenever you have these a property crisis in any country, it's not there's nothing specific about China. You get this in in the US or Ireland or anywhere where we see property crashes. Is there'll always be this other hidden level of debt, and so and that's where there's shadow banking. We've seen a few shadow banking issues maybe last month, 3 or 4 months ago, but hasn't gone away, but sort of nothing really popping up at the moment on that. We'll go back to you, Sam.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now, direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show. So Damo, we've had a question come through from Adam. He's asking, does the China relationship play much of a role in Australian or US bond prices?
Yeah, I'm guessing we're talking about long-term bond prices here. So for Australia, look, Australian bond prices are largely run off the US, but in the longer term. In the shorter term, they don't. But in the longer term rates, and we've seen that's markedly over the last little while, where we've seen the Australian bond yield curve react much more to what is happening in the US than to what's happening within Australia. I think there's probably a part by saying if we're seeing a further and further widening of or worsening of relationships and trade relationships, then you'd probably expect that to be mildly inflationary. Is it that might add a little bit to inflation over as you know, China's often the lowest cost producer, and they're happy to subsidize companies in order to make sure that they're producing even cheaper. And so, and case in point is electric vehicles, or just similar before that was solar panels, where China was basically happy to subsidize solar panels locally so that it basically put solar panel manufacturers around the world out of business. Now that was bad for solar power manufacturers elsewhere, but it was good for people buying solar panels because effectively the Chinese government was subsidizing the cost of your purchase. So in a way, I'd be saying, I'd be saying that, you know, the worse the relationship between China and the rest of the world, or the rest of the developed world, then you can probably expect a little bit higher inflation. But I don't think it's going to be a primary driver of the bond yield curves. So yeah, and getting back to China, so that the other place you can get is the consumers. So could the consumers rescue us? And I spoke a little bit about how, you know, the consumers in China really aren't being supported. So China does seem, and probably more importantly, Xi seems to have a philosophical view that you don't just give direct handouts to consumers, that yes, you give handouts to companies and you give handouts to state-owned entities and things like that, but consumers are not where you should be putting your money. And so that's sort of a negative for the for consumption. There's a few other you've got a few other issues. One is your youth unemployment. So they're some of your biggest spenders, and the last we saw, you know, it was well over 20%. Now we have no idea because they've stopped publishing the statistics on it. But I think it's also worth. I've got a chart up I just wanted to highlight on that same front, which is just one that's showing the difference between the number of college graduates or university graduates in China versus the number of service employees. And they've actually started going in opposite directions. And so what does that mean? Well, if you've just finished a degree, chances are you probably want a services job. There's no, if you headed for manufacturing, you probably didn't need a degree. You probably could have just gone straight into it without the degree. And the issue China's got is that just as, we're starting to see this really sharp spikes up in terms of the number of people graduating colleges and universities, the jobs are actually fading away in that area. So, so tough to see that consumers are going to come to the rescue while that's happening. There's also some pretty terrible demographics going on. Got a new mirror chart up, just sort of showing that the China, in terms of its population structure, comparing that to Japan. So Japan all sort of started, from a GDP perspective, really started to fall apart in 1990. And we're seeing that China, its demographics are clearly on the downtrend. The aging population and declining fertility is really making a difference as well. And you're seeing that the population of China is aging very quickly, and will probably catch up with Japan. Or sorry, not catch up, but it'll certainly catch to where Japan was when it started to have problems in the not too distant future. And then the other thing is, and that's just based on the demographics that we know. So there's been a few revisions to numbers. So I've got a chart just up showing how the difference just between 2019 and 2022. So this is UN population estimates based on the slide, was that they were looking at, in 2019, they were sort of going, well, yeah, China's going to shrink, and because of the demographic changes we've seen, that they'll by 2100 they'll have 600 million people. Whereas fast forward 3 years, and now they're talking about 400 million people because of the demographics are just looking so much worse. There's been a significant amount of government support for people to have more births. So they went from one child to, okay, now some people can have more than one child. If they're an only child, they have more, then to two children, and then to three children. They're actually been actively trying to push the fertility side, but it's been going the other direction. It's actually been going down. And there's a reasonable argument out there that, as with most China statistics, if you incentivize all your local officials to, in order to have more births, they may go out and do some programs that will help, but that's a sort of a maybe not. But actually, what's almost certain is that they will actually report that they're doing well on those. And so there's some number of statistics showing out there that are basically showing that the number of births that China's reporting, which are very, very low, might even be overstated by vast amounts as well. And that's partly why we've seen some of these significant downgrades in projections. And so what that means as well is, for anyone who's had kids, kids are expensive and you spend a lot of money on them, and they're a good source of retail sales and a lot of that consumption side. And so if China's having fewer kids, then that just means that's one more reason for consumption and consumers to not be riding to the rescue of the economy anytime soon. The other thing is that deflation is what you're seeing within China, and that's not a positive for consumers usually for spending. So the idea is that if you've got inflation, then it incentivizes people to spend money, because it's, well, cars keep going up in price. So thinking about buying a car, I'll buy one now because they're going to go up 5 or 10% over the next year. Whereas if you've got the opposite happening, if you've got deflation where you're thinking about buying a car, but you've seen prices fall by 5% over the last year, is you might be more likely to hold off in your purchase and buy a better car at a cheaper rate for the same price. So so that doesn't look like so we're not looking like consumers to the rescue. The other thing is, this whole idea of financial repression. So effectively what China's doing is they've kept their interest rates lower than what they've kept their interest rates quite low, and they've basically pushed a lot of the money across into the into government spending and corporate spending, and a lot of capital expenditure in particular. And so while China was quite asset poor and didn't have a lot of capital, that was really good. So basically what you do is you make everyone a little bit poorer, and you use financial repression. So basically interest rates that are too low, you let companies borrow at interest rates that are really low, and you don't pay the savers. You take away from the savers and you give to these corporates. And what that means is the corporates go out and spend all this extra money, and they spend all this capital expenditure, and that's often really good for poorer economies. And so those economies grow really quickly. But then you reach a stage where you've reached your capacity limits. There's only so many bridges you can build. We spoke about the bridges before. That the first bridge across the river is really productive because it saves people all this time of driving around, and then the second bridge might be relatively productive as well because of the congestion on the first bridge. But by the time you're up to the 15th and 16th bridge, you're really not doing a whole lot. But it still costs you the same amount as the first bridge, possibly more if the area's sort of grown up and done things like that. So productivity in China very much stalled. We've got this financial repression going on, so we're basically transferring money for consumers still to corporates, and I guess what I'm saying is it can't both be a cause and a cure. So that's part of a lot of the problems they've been having is because of this financial repression. So now if they're going to lower interest rates in the view to try and get the economy going again, well, if you're lowering interest rates that are already at a repressed level, you're sort of making things worse in a way, in that you're taking more away from the savers, and giving more to the corporates in terms of the cheap loans. And if you've got lower interest rates, as you do in China at the moment, you see a falling currency that actually helps companies and punishes households, because for a household means, okay, if you're interested in buying, say, the new iPhone, and your currency just falls 10%, okay, now the iPhone costs me 10% more. If I'm a company though, and I'm exporting, say, an electric vehicle, my currency falls 10%. Now that electric vehicle is 10% cheaper for somebody to buy it in the US. And so, the falling currency, is just further repressing that household, and meaning one more reason why the household isn't going to, pick up its share, and same with that lower interest rates. And that sort of brings us to the last point I had on this was, that keep in mind there's this impossible trinity that everyone's trying to manage, all countries. So basically, what the idea is you can't have a free capital account, a fixed exchange rate, and sovereign monetary policy. So let's say you want to use, let's say you're Argentina, and you're having all these debt problems, and one of the solutions they've suggested is basically using the US dollar. Well, that effectively means you no longer have your own internal monetary policy, because you might be on a fixed exchange rate, but you've lost control. Now that the US central bank is going to put up rates up or down because of its currency, it's not going to care about yours. So you've got to manage which ones of these you have. So most countries go with the a floating exchange rate and free capital flows. So they don't have a fixed exchange rate. And then that means they can run their own monetary policy. China's effectively sort of tries to spin some plates in a little bit, but it's got a sort of a dirty float in terms of how it manages its exchange rate. It's sort of largely fixed, but probably more fixed than not fixed. But then they don't have free capital flows either. They've sort of got a mixture of free and certainly more restricted capital flows. So, I guess in the end, where I'm getting to with this is you can't run away from this trinity. You have to sort of crack down on. You have to assume one of them is going to. You have to give up on one of them. You can't do them all. And so I think that's where we're looking and saying, well, the capital flow is probably still going to be locked up, and so that means that they get to run their own sovereign monetary policy, but they are limited in terms of what they can do to alleviate these problems, and they're already sort of doing everything they can and running into these debt problems.
Excellent. So now we have our question of the week. So this is for viewers to have some discussion in the comment section over the coming days. So the question for this week is, should Australia be trying to do deals with China? So feel free to post your thoughts and engage with us and some of the other viewers over the coming days. So Damo, back to you for the investment implications.
Yeah, so just want to do that just quickly on the, I guess the three different versions of China is, your bull case is you return to the old days of construction, in which case, buy the iron ore miners, probably a bunch of other miners as well. You can sort of try and get in on any of these companies that, that any of the exporters we're looking at into China. We think that is very unlikely. And as each day goes past, it looks more and more unlikely. China's had lots of opportunity to go back to the old days, and it looks like they've pretty firmly decided not to. The base case is that we get quite a lot of stimulus and enough to sort of avoid a disaster, but basically we're ending up like Japan, a worse version of Japan though, after its construction boom. So a long period of workout, a long period of subpar growth. And that still looks like the base case at the moment. Seems to be very much what's been happening for at least the last year, and doesn't look like, from our perspective anyway, that there's any change to that. But keeping in mind that there's this bear case as well, is that the stimulus is, that China keeps having to come up with new measures, and they have to keep coming up with more money, and they have to keep coming up with keep bailing out these property companies as they fall over. And that, if they get the calculation wrong, or if they change their mind on how they want to deal with it, then you will get a sort of replay of the financial crisis. But, with fewer links to the rest of the world, admittedly. But, you do have that bear case sort of hanging over you at some point. But keeping in mind, for us, the base case is very much a worse version of Japan's.
Excellent. Nice one, Damo. Thanks for that. I mean, the statistics are pretty overwhelming. And, no doubt we will be commenting on this in the future. Just one other thing I want to add, the listeners would have heard we have all the screens and tilts for all the portfolios. Depending on if you're bearish or bullish on China, you can add in or remove, add an extra exposure or remove the GICS sector materials. So that would be, iron ore included in there. So that's something to consider. So that pretty much wraps us up for today. So thank you, Damo, again, for sharing your views and your insights. Excellent. So we do welcome your feedback on this podcast, especially in regards to suggestions for future topics. Adam just put a good one through just before. So that was about loving to see a future episode on bonds and yield curve explanations. I know it's, for lots of people, it's a bit of a mystery how that works. So, we'll do an episode on that in the coming weeks. If you do have any ideas, please send us an email to contact@nucleuswealth.com. And also, if you know of anyone that might get some value out of today's episode, we'd really appreciate it if you do share it with them as well. So for myself, Damien, and the rest of the team at Nucleus Wealth, thanks for watching, and we look forward to seeing you next time. Bye for now.